The U.S. economy growing at the best pace in 4 years in the second quarter. Now all eyes are on the Federal Reserve's next interest rate decision. Our next guest argues that the central bank is already behind the curve. In a Wall Street Journal op-ed, Martin Feldstein, former chairman of the Council of Economic Advisors under President Reagan, writes, quote, "Save low interest rates for a rainy day," adding, quote, "It's important for the Federal Reserve to raise the Fed funds rate to 4% over the next 2 years." Martin joins us now. You know, President Trump, just voicing his opinion on CNBC on this matter, says the Fed is tightening too much, too fast. Are you arguing the opposite here?
I guess I am arguing the opposite. I think, you know, the federal funds rate, the rate that the Fed controls directly, is less than 2% at a time when inflation expectations and actual inflation are both 2%. So that means the real interest rate is negative. And the Fed should have started raising interest rates a few years ago so that asset prices wouldn't be way out of line with reality.
So you're saying what, the stock market's a bubble?
If it's not a bubble, it's very close to a bubble. The S&P 500 price-earnings ratio is now more than 50%, 50% higher than it has been on average historically. So that's way out of line, and it makes the whole situation very fragile.